What's going on, guys? Jeff here. Today is Thursday, and I'm not gonna do this for too long because right now is exactly 9:31 and the CPI data is out. So we'll go through the CPI. Right now, you have to really understand this huge issue right now. The charts, everything is dropping, and it's crazy because I kind of expected all of this to kind of drop. We reported 0.6% month over month for the January CPI index, which brings up the year over year to 7.5%, where the expected was 7.2% year over year. So let's see what are the interesting outliners for this current month. Of course, people were expecting about 0.4%. Even CNBC is going through it as well. Yeah, inflation rises 7.5% over the past year, even more than expected. Okay, so let's go through the where do we have the graphs? Okay, same thing. Let's look at the seasonal adjusted from December to January. Things that actually went up. Okay, nothing much on the food side of things. Ooh, fuel oil up by 9.5%. So I'm pretty sure your Exxon Mobil, the BPs, all of them should probably be doing quite well. Oh my God, the market is crashing. Apple is down a percent. Google is down a percent. Ford is down a little bit more than a percent. Snapchat down 3. Palantir down 2. Oh my God, this is great. This is great because I really, really expected this to happen, and yeah, that's crazy. Okay, anyway, let's go back. Let's go back. Okay, electricity went up by 4.2%. Airline fares went up by 2.3%. Overall, from this entire report, you would most likely be looking at the fuel oil only. But if we actually get into the fine comb details of it, you should be a little bit more intricate for it. Flour up by 2.9%. The cakes, cookies, in general, people who bake is going up. Okay, pandemic people stop baking. Come on. Nasdaq futures falls as yields spike on hot inflation report. Oh my God. Let's see. 10-year Treasury yield. Let's check it out. Oh my God, this is crazy. Come on. Okay, market watch is gonna hang. Okay, cool. Sweet rolls. Okay. Beef kind of uncooked beef kind of going down in price. Pork kind of going down in price. It's good that we are actually seeing some sort of deflationary trends as well. Okay, uncooked poultry, including turkey up 4%. Fresh fish and seafood. Okay, let's see. Dairy products. I want to see like those explosive numbers. Those are the ones that I'm very, very interested in. I don't get citrus fruits still going up. In the December report, I actually said that chances are the citrus fruits are going up because of Chinese New Year, where people usually bring mandarin oranges and oranges to do the visiting and such. So yeah, I'm assuming that that's probably the case for this increase in price, but I'm not sure. Tomatoes dropping down 3%. Canned fruits going up 3.9%. Do we have any explosive numbers though? Because all of this kind of look pretty normal. Peanut butter up 3.1%. Frozen and freeze-dried prepared food 3.7%. Okay. Let's see. Do we have some? Yeah. Okay. Fuel oil 9.5%. But for your propane, kerosene, firewood down 3%. So 4.2% on electricity. Okay, I want to look at the used cars and trucks. I think that's going to be one of the main thing that we really want to look at. The housing side, the furniture side of things, pretty boring. Nothing more than 4%. Dishes, flatware at a flat 4%. Let's see. Oh, men's pants and short down 5%. That's great. I guess people are starting to go back and then prices are starting to go down. Outerwear for women up by 6.5%. Let's see. Do we have something that is like crazy big? It doesn't look like it. Okay, so let's see. Oh my God. Okay. This is really, really good. Okay, this is superbly good. Okay, over here, let's look. New vehicles, 0%. New cars and trucks 0%. New cars going down 0.2%. New trucks 0.2%. Okay, so although from the report itself it sounds good that we're actually getting 0%, basically staying around there and even having a little bit of a deflation trend. So this is what we call disinflation trend. However, the issue about new cars and trucks and all this, the issue about them having low numbers can kind of be coming from two different contributors. So the first thing is that the first scenario actually comes from the fact that cars and trucks basically do not raise up in price. There is a steady supply and steady demand, hence we are getting this sort of prices. The second scenario, which I feel that is going to be way more possible, which should be that prices are staying the same because they are not selling enough. Simply because demand is so high, but the supply chains are still having a lot of issues and they cannot really deliver the cars out in time for them to really match up with the demand. Hence, that way they are unable to really meet up with the demand and they are unable to kind of sell the cars out on time. Used cars and trucks though, up 1.5%, which is pretty good. This is what we call a disinflationary trend as well. Over here, 3.3% for the last month. Right now, we're looking at 1.5%, which is pretty good. We do want to see it going down a little bit. And of course, in the next few months, we do want to see a deceleration, like drastically, actually down towards a deflationary trend for us to actually get back to a pre-COVID used cars and truck prices again. Okay, motor vehicles up 2.4%. Motor oil 2.9. Let's see. Do we have anything else? I think that's about it. Miscellaneous personal goods 3.5%. Okay, honestly speaking, I think it's just car and truck rental down 7%. Oh my god. Okay, this is pretty good. This is pretty good. Okay, so for people who do not know, I think it was back in one of the 0.9% month-over-month data where we actually saw like the cars and trucks rental actually skyrocketing because people were unable to get their cars. Used cars and trucks were also too high. People do not want to buy the used cars and trucks, and basically people were just renting the vehicles in order for their own personal use or for them to actually go do their own work and such. And for the few months that we actually have been getting for the cars and truck rental, it's actually been going down. And this month having negative 7% month over month is huge for this, because not only are we in the disinflationary trend, we're actually moving closer to the deflationary trend. Honestly speaking, I think if people were to digest this entire report, chances are that the market will most probably recover a little bit. That's my point of view. Personally speaking, I feel that there is a good chance that the market would want to recover on this kind of news, because right now, honestly, when I actually look at the things, when I go through every line one at a time, there's nothing that's particularly shocking. I don't think the fuel oil was exceptionally surprising for me. I feel that was quite well expected. If anything, the surprising fact was this negative 7% on car and truck rental. For us to really see this sudden shift in the inflationary trend for the cars and trucks side of things. But yeah, other than that, food, your clothes, your gasoline. Okay, well, gasoline is all right. I think it's mostly the fuel oil. But yeah, I think this report is basically pretty good. It's just that it's a little bit disappointing for us to really see 0.6%. Of course, it will be a lot better for the market to really see a 0.4 or 0.5%. That way we can actually be somewhere in the estimates according to what the analysts actually expected. But yeah, right now the market is kind of down a little bit from this report. Let's see over here. The QQQ down 1.2%. Let's see what SPY is doing. SPY is down a little bit less than 1%, about 0.8% or so. So yeah, that's kind of all for the CPI. I think that a little bit sad that we're going through a 7.5%, but nevertheless, okay. Now we can cover some news today. Okay, so inflation accelerate to 40-year high. Oh my god. Okay, honestly speaking, I think when people see this sort of headline, it kind of scares people a little bit. For people who do not read the report every single month, like myself, they do not really understand when they actually see this kind of inflation report. They just hear, "Oh my God, we're in a hyperinflated environment." Of course, I'm not saying that we are in a transitory inflationary environment either. Of course, inflation is real, inflation is happening, but at the same time, we also have to take into consideration that inflation is only happening to certain part of things, and the most part of what we're actually spending our money on are not really being affected as much. Of course, right now the supply chain being affected, and also with the demand slightly being higher, and people have a lot of sort of cheap money in the system right now. People are also having a lot more purchasing power, and people are just basically just getting rid of everything on the shelf, trying to just hoard onto all these other items that is being listed on the CPI. But if you actually go through the entire CPI like we just did just now, food prices are still around the same prices. Of course, some of them do have nominal up to like 1 to 2% increment. Understandable, but of course they kind of do have some sort of disinflationary trend afterwards, and they kind of just go back down after a few months or so. So those wouldn't be my immediate concern. Electrical charges are also going up a little bit, but of course, to a certain extent, it is quite minor in my opinion. Of course, for electrical side of things, it is harder for them to really see a deflationary trend, because when you actually increase the price, it's harder for you to really bring down the price. For apparel side of things, I think that's very, very subjective. It's really up to who is the consumer of things. Like for example, for myself, if I do not want to buy the clothes, it's not going to affect me. However much the price of the apparel is, however much the pants is, I don't care if it's going up in price, down in price. I'm not the one buying it. It doesn't really concern me. Same thing for someone who do not even own a car. Telling them that the fuel oil is up by 9% wouldn't really affect them at all, because I'm not driving. I wouldn't need to care about it. But if we actually look at the market side of things, of course, people when they actually hear, "Oh my God, we're getting 7.5% year over year, 40-year high," okay, easily scaring people into selling whatever they have. People will tend to paper hand during this period of time. So of course, people will definitely want to kind of find the FUD in this scenario. Okay, U.S. inflation accelerated 7.5%. Now we already went through that. Okay, reflect. Blah, blah, blah. Prices for auto, household furniture, and appliances, as well as other long-lasting goods, continue to drive much of the inflationary surge, fueled by pandemic-related supply and demand imbalances. Okay, the auto didn't really do much per se, but okay, most economists expect the dynamic to fade as businesses adapt to demand and adapt and demand normalizes. Okay, so like what I said before, I think that this is starting to look like a bit of a peak of what we're actually having in a hyperinflated environment. Honestly speaking, after looking at such a report for the CPI for January, I think I'm a lot more milder per se for the February, March. I think February will still be seeing a little bit left of the inkling of the inflation that we actually been having. But I think as of March or April, we will most likely be seeing a good disinflationary trend or even deflationary trend happening, where we actually start to kind of cut back down on the year-over-year data. We might be starting to see an inflection point downwards, where we can see maybe about like 6.5%, 5%-ish year-over-year data for about April, May, or April, May-ish, personally speaking. So yeah, I don't think it's going to be that big of a issue for us at the moment. Let's look at food inflation, also raising consumers' grocery bills, pushed up by steady price increase for meat, eggs, and citrus fruits. Energy prices gains have shown signs of easing after climbing steeply last year, but a recent sharp rise in crude oil prices threatens to keep gasoline price elevated. Yeah, okay. These are basically everything that I've been talking about. So that's fine. Okay, let's look at what Bloomberg actually reported for this. Okay, Bloomberg. Okay, U.S. consumer price up. Blah blah blah. Of course, we already know that. Okay. Higher food, electricity, and shelter costs. Let's see the shelter cost. I actually did not see how much is the away from home shelter cost, because I'm almost certain that that's usually up during this period of time. Let's see. It should be here somewhere. Okay, owner equivalents. Let's see. Let's see. Do we have something ridiculous here? Huh. Haircuts. Okay. It's not in this one. Ooh. Okay. Shelter. Okay. Lodging away from home. Yeah. Like I said, lodging away from home. Down 3.9%. Other lodging away from home, including hotels and motels, negative 4.2%. Honestly speaking, we're starting to see some sort of a deflationary trend over here. So I think we don't want to be absolutely like frightened about it per se, but of course I don't think we should be complacent about it either. Of course, this would be kind of better for Airbnb because this would most likely be attracting a different crowd of people who want to travel a lot more due to the price constraint that we actually were having before. So yeah, okay, excluding volatile food and energy components, so-called core price, the blah, 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 okay, nothing interesting. Nothing interesting. Yeah, 0.4%. We're expecting, let's see, steady runner. Okay, with the help of massive government stimulus, a surge in household purchases, strained factories and global supply chains, capacity constraints of US producers trying to ramp up production were made worse by a smaller pool of available labor. Yeah, okay. Nothing interesting again. Let's see. Do we have anything else other than this? Okay, I do want to read out on the Twitter one, but I'll check that later on. Let's see if we have anything else on Wall Street Journal about this. Ooh, okay. Interstate, Credit Suisse. Ooh. Unilever says soaring costs will eat into profit. Okay, let's look at Barron's. Um, okay, let's see Barron's report on inflation. Okay, 7.5%, same thing, same thing. Okay, developing story. Okay, they're slow. Whatever. Okay, Disney. Whoops. Okay, Disney earnings were out yesterday. At after hours. And they basically beat on everything and even have better subscriber growth forecasts, which is kind of like a stab at Netflix, as Netflix were unable to do so. So I think Disney might be very, very interesting for us to look at. Disney right now in the pre-market up 6%. Of course, I'm pretty sure that this CPI report probably did affect its prices a little bit. Yeah, it did. So before the CPI dropped, they were actually doing around 158. Wow. Okay, so they're actually up about like 7% ish, almost 8%. But now they're down to like about 6% ish. So yeah. Yeah, I think for the Disney side of things, if this actually works out well, of course, Roku would have to be looking at their reports. Hulu have to look at their reports. Comcast have to look at their reports. Because after what Netflix actually showed us, we were actually very, very cautious about what we would be expecting from all these streaming companies for us to really understand where the consumer mindset is really at. So yeah, okay. Structural streaming concerns also remain top of mind, including whether Disney Plus can develop content to broaden out beyond its Disney, Marvel, Star Wars fan base, and if Netflix show a slow growth patch suggests a corollary lesser streaming total addressable market, the margin outlook for its competitors like Disney Plus. While Disney future is closely tied to streaming success, the company today is still more of a legacy media and entertainment business, which is also what I said about Disney before. As much as Disney is trying to really go on to a more tech-based, more online side of things rather than offline side of things. Ultimately, they are still a very legacy style business where they do make most of their money from the offline side of things. So it's very hard for them to really fully transform. Of course, they're also getting into the NFT side of things. I'm pretty sure there are people talking about the NFT for all the Marvel superheroes and such. So yeah, I think Disney is going to be a very, very interesting company to look at for the next 5 to 10 years. I think there will be a lot of changes to come into Disney to really see what Disney can actually uphold. I think Disney Plus was really a good direction forward for us to really see streaming services for all the Marvel, Star Wars, and Disney side of things. I'm pretty sure that the fan base for all these are a lot bigger than what we have for Netflix, as people are more towards the casual streamers where they are just watching the shows as it is. So yeah, I think Disney is going to be very, very interesting, which is why I've never really been a bear on Disney. I did buy puts on Disney just to give you guys full transparency. But I used to buy puts on Disney due to bad macroeconomics outlook instead of because of the company itself. Okay, let's look at CNBC. Okay, can we have the 10-year? Oh my god! Oh my god! Just look at that! Just look at that! It went up all the way to 1.98%. Oh my gosh, that's ridiculous. Okay, so people are, yeah, okay. I mean, definitely nothing I can say about this. This sharp increase. I would like to say that I kind of expected it as well, which is why I've always been buying puts on companies. I have also been telling you guys that I've been buying puts on companies as well. So nothing to really talk about that. Let's just look at this. Nasdaq futures fall as yields spike on hot inflation report. Consumer price rise at a 7.5%, hotter than expected, the largest reading since 1982. Yeah, in September we're looking at 1.5%. Right now it's at 1.98%. That's ridiculous. The market didn't like it. Well, clearly, pointing out that the 10-year has been making a run at 2% yield this week. Today's probably the day we are going to be seeing 2%. And that's crazy because if we're looking at 2%, the rate hike that we're going to be getting on the 16th of March is definitely going to be 25%. Without a doubt, for people who still dare to talk about how a rate hike is still a unknown, I'm just telling you right now, we are getting a rate hike on the 16th without doubt. And of course, for people who are unaware, on the 16th of February, we'll be getting the minutes for December's FOMC meeting. So we will probably be going through that as well. No, we'll be getting the minutes for January FOMC meeting minutes, and then on the 10th or 12th, no, I think it was the 10th. I think on the 10th of March, we'll be getting the CPI for for February, and then on the 16th of March, then we'll get the FOMC meeting when Jerome Powell actually addresses the entire press conference with the FOMC results. So yeah, those are basically the catalysts I'm looking for right now. All right. Anyway, let's go through some news, I guess, whatever. I'm pretty sure that people are not really interested in news after looking at this horrible inflation report. But I'm not gonna lie, I'm actually quite hyped about it because I don't really see that much bearish point on this report as much. So yeah, Americans are paying about twice as much for gasoline now as they were early in the COVID-19 pandemic, and the high prices of fuel is costing consumers away from the gas pump to contributing to decades high inflation on a range of goods and services. When oil becomes more expensive, so does everything else, and $20 doesn't go as far in a car's fuel tank. Yeah, I'm pretty sure that we already talked about Brent oil prices, how we are possibly going to be hitting $100 per barrel this year. And yeah, I think that's all they actually talk about this in this report. Inflation. Let's see. Do we have anything else on the Wall Street? Let's see. Oh yeah, Coke actually posted their earnings as well. Coca-Cola getting 10% on revenue, if I'm not mistaken, from a headline reading when I was at dinner. I saw something along that line. Okay, let's look at Twitter. Twitter is crazy because Twitter, Kathy Wood was a little bit bearish on Twitter after she sold off some of her Twitter stocks for her ARK side of things. Let's look at Twitter. Wow, okay, Twitter is up 2% even after the entire CPI. That's pretty good. Okay, let's look at it. Twitter announced a $4 billion stock buyback on Thursday. Wow, okay, which helped buoy its shares amid an otherwise lackluster earnings report. That's pretty smart because if they actually do a buying back program, that will easily kind of boost up the price, kind of like trying to maintain the investors' confidence in the company. Of course, usually people do this when they have a well, sort of like a bad earnings for them to kind of still instill the so-called confidence in the investors that you don't have to sell, okay? And even if you were to sell, we will buy it back from you instead, that sort of thing. So revenue in the holiday quarter rose 22% to 1.57 billion, which is pretty good. Slightly less than analysts had predicted, but suggesting the company has weathered recent change by Apple on data privacy better than some larger rivals, such as Facebook, clearly. Sales in the current period will be as much as $1.27 billion, Twitter said Thursday in a statement, while the average projection was $1.26 billion. So that's the issue with the reports right now. When you actually hit the estimate, the prices will go down because people expect you to destroy the estimate, which is kind of stupid because right now that's kind of how it is for tech companies. If you are going to be reporting, you are not supposed to just beat your estimate. You're supposed to destroy your estimate. That's how you're going to make money. Okay, so I'm going to be going through the earnings report for the Twitter later on so that I can kind of understand it a little bit more. Of course, I do not have any more any exposure to Twitter anymore, so I don't really need to care about it as much. But I am quite curious, so I'll be going through that later on. Wall Street analysts, on average, estimate Twitter's revenue to increase by 20% in 2022. That's pretty good. Because if you're actually looking at revenue at that high, yeah, personally, I think that is pretty bullish. So yeah, okay, there's nothing much on Twitter as well. Okay. Oh, come on. Okay, stop trading ban for Congress hits pushback from right to left. Okay, so for people who are unaware, Nancy Pelosi actually came out to say that she want to ban lawmaker from actually making all these trades. And it's kind of ironic because she's one of the well-known insider trader, allegedly, of course, allegedly. She was allegedly known as one of the biggest insider trader in Congress. And she's the one that actually came out to say that, lawmakers, we can't be making all these trades. And of course, a month ago, she basically came out to defend herself where she was doing trades with possible insider information, of course, allegedly. And she actually just came out and said, we're in a free market. We definitely have to allow trading for anyone, even if it's for the Congress people. And now she basically just U-turn on it and kind of say, yeah, we probably shouldn't. Chuck Schumer endorsed the general idea. Okay, Nancy Pelosi, bowing to the growing momentum within her party, retreated last month from her previous opposition to a stock trading ban, but hasn't yet fully embraced it. Well, I mean, afterwards, Nancy Pelosi can basically just ask her husband to do all the trading, so I don't think that's going to be that big of an issue. I do believe in the integrity of the people in public service, whose husband, Paul Pelosi, made his fortune in real estate and venture capital. It's complicated and members will figure it out and then we'll go forward with what the consensus is. I mean, I think this is still going to be a progressing story. Honestly, with politics in the United States, something I really realized is that whatever bill that you're going to put out, whatever ban, whatever law that you're going to put out, it's not going to be final until someone actually says so. So right now, whatever we're going to be talking about, it's not going to be completely true until it is actually true. So there's not really going to be much point of us actually going through and fro, back and forth about it. So yeah, Disney Beats. Okay, we know that. Let's see. Yeah, we already talked about this yesterday. So yeah, I think that's about it for the reports that we actually have. Yeah, I think we don't really have. Oh, okay. I do want to talk about this a little bit. Peloton CEO Barry McCarthy first all-hands meeting cut short after laid-off employees crash it. So apparently, for people who are unaware, Peloton are going to be cutting off 20% of their workforce. Of course, these are all the office workers. That would be amounting to 2,800 workers of them. So all of them are going to be laid off. And apparently, these 2,800 workers, a few of them were actually being given a link to the all hands meeting, virtual meeting, and yeah, it was kind of hectic because basically people who are going to get fired were fired via the virtual meeting. It was kind of bad. So yeah, I'm selling all my Peloton apparel to pay for my bills. It's awfully tone deaf. The company messed up by allowing people who were fired into the chat. Towards the end of the conversation, McCarthy was asked if employees who has been laid off had somehow gained access to the chat, to which he replied, no comments. Uh, the funniest thing that I actually saw on Wall Street Bets was this. Okay, the connected fitness equipment maker is slashing costs across its businesses, and part of that will come from the elimination of 20% of its corporate workforce, or 2,800 jobs. Peloton fitness instructors will not be affected. And afterwards, this is the funniest part, okay? Peloton has offered affected workers cash severance, career services, and a monthly Peloton membership for 12 months. So basically, the Wall Street Bets meme that was going on about it was saying it's like, Peloton firing 2,800 employees and giving them a year worth of Peloton membership is basically like your girlfriend dumping you and giving you a year subscription to her OnlyFans. But yeah, it's just kind of funny that like that's what Peloton thought that would be that cherry on top. We're gonna fire you, but don't worry about it. We're gonna give you a year membership for Peloton. Like, as if I want that. Like, come on. Oh my god, I can see why people are saying it's so tone deaf. But yeah, okay. Anyway, that's all I have for today's news, and it's already over 30 minutes. I do not want to drag this any longer, and I'll be going through the news a little bit, and I have to spend some time with my sister who just came back from the UK. But anyway, thank you guys for watching, and I'll see you guys